You think the global economy is stabilizing and your hard-earned cash is completely safe inside your retirement account. But the harsh reality is that you are quietly being set up as the ultimate exit liquidity for central banks and global billionaires. Comment your current age and the exact dollar amount you invest every single month right now, because this massive hidden financial mechanism is going to completely reshape your personal wealth, whether you like it or not. The global gold market just witnessed one of its most bizarre days in modern financial history, with news breaking that Russia aggressively dumped $43 billion worth of gold, bringing its total sovereign holdings down to the absolute lowest level since the conflict began in 2022. All over social media self-proclaimed finance gurus are screaming that the gold dream is dead and that prices are set to crash down to zero, but data never lies. This 28-ton reduction represents a microscopic 1.2% of Russia's total gold reserves, which means it is barely a drop in the ocean. Yet the mainstream media wants you to panic, so you panic sell your assets right into the hands of institutional buyers. Before we unlock the massive variables governing this economic circus, let us lay down the core truth you need to hear. If you want to achieve true financial freedom and avoid getting absolutely crushed in these macro shifts, you must stop chasing hyper-hyped speculative trends and stop trying to time the volatile market, because time in the market always beats timing the market every single time. The smartest financial decision you can make today is to ignore the sensationalized headlines and commit to a disciplined long-term strategy by automating your wealth accumulation, instead of gambling on short-term commodity fluctuations. Look at real practical wealth-building tools like opening a Roth IRA or a tax-advantaged individual brokerage account and consistently dollar-cost averaging into broad market index funds, like VOU, which tracks the top 500 powerhouse corporations, or rock-solid dividend growth exchange. Traded funds like SAGD. Standard passive investing works beautifully when you stay disciplined, but you must understand that the exact same mechanism making index investing convenient also forces automated funds to buy into structural shifts. To counter this systematic risk, you need to maximize your personal savings rate by aggressively cutting down your lifestyle inflation. Stop financing a $70,000 luxury vehicle just to look rich on social media, and instead choose to drive a reliable 2006 used car while living in a minimalist, low-cost space until your investments generate real passive cash flow. Building true wealth is not about buying into the latest trillion-dollar hype train, but about consistency, discipline, and holding productive assets for decades. Now let us break down the geopolitical plumbing to understand exactly how the global elite are moving the pieces. Bloomberg recently confirmed that as of May 1st, Russia gold holdings dropped by 900,000 ounces down to 73.9 million ounces. At recent market averages hovering around $4,800 per ounce, that equates to roughly $4.3 billion liquidated. Sounds terrifying on paper, right? But let's look at who we are talking about. Russia still holds 2,305 tons of physical gold, making it the sixth largest gold holder on the entire planet, right behind global giants like the United States. With 8,000 tons, Germany with 3,000 tons, and China, Italy, and France holding around 2,000 tons each. This $43 billion liquidation is a rounding error in their total portfolio, and it was executed as a slow linear sell-off, not a massive panicked market dump. Why did they do it? The answer is remarkably simple, and it has absolutely nothing to do with them being bearish on gold. They are simply running out of immediate liquid cash. The conflict has dragged on for over 3 years. Energy sanctions from Europe have severely choked off their oil and gas export revenues, but their military defense budget demands an endless mountain of capital. According to recent financial filings, the Russian finance ministry has been systematically selling off gold and foreign currency assets from its national wealth fund to plug the exploding budget deficit caused by declining energy revenues. The central bank reduction is merely a mirror mechanism to hedge operations in the domestic market to stabilize the Russian ruble. Simply put, the central bank did not want to sell, but the finance ministry desperately needed cash to fund the military machine. Here is the critical timeline you must understand. The Russian central bank completely stopped buying gold at the beginning of 2020, a full 2 years before the major conflict erupted in February 2022. This proves the state was hoarding massive cash reserves well in advance, buying up almost the entire domestic gold mining output for 2 straight years. Once the conflict went live, that hoarding phase ended, and every single dollar had to be redirected into the bottomless pit of defense spending as we entered 2024 and progressed deep into 2026. The continuous linear selling became necessary because the defense burden expanded and the ruble depreciated too heavily. Without liquidating gold reserves, the currency would have collapsed. So is this an isolated incident or an alarming global trend that should make retail investors run for the hills? The answer is a resounding no, because this exact operational playbook has played out multiple times across different nations. Take Turkey, for instance. In 2024, the Turkish central bank engaged in a massive gold liquidation, dumping over 100 tons of gold in the first half of the year alone, for the exact same structural reasons. The Turkish lira was experiencing catastrophic hyperinflation. Their foreign currency reserves were completely depleted, and they were forced to sell gold to acquire US dollars to survive the currency crisis. Back then, retail investors panicked and screamed that gold was going to crash to zero, but instead, gold prices ignored the noise and broke to new all-time highs, because the institutional market understood that Turkey was selling out of desperate necessity, not strategic bearishness. Look at Poland. The National Bank of Poland also conducted gold liquidations due to immense domestic fiscal pressures as they rapidly expanded military defense spending to counter regional security threats. When cash ran low, they tapped their gold reserves, but their total volume was too small to dent global market demand. Then look at China. Data from the World Gold Council shows that after the Chinese central bank boosted its gold reserves to a peak of 2264 tons in November 2024, it paused its monthly buying operations. The mainstream media immediately spun a narrative that China was done with gold signaling the top of the market, but if you analyze the data objectively, China did not abandon gold, they simply paused accumulation at historic high prices. Because a 2264-ton baseline gives them massive geopolitical leverage. When you look at all these case studies together, the underlying economic law becomes crystal clear. Whenever a central bank dumps gold, the reason is always rooted in fiscal emergency defense spending or extreme currency depreciation. Not a single central bank sells because they think gold is a bad investment asset. This is entirely different from panicking retail investors who cut their losses and sell at the bottom of a market cycle. If you look at the macro picture, global central banks are not net sellers. They are net buyers purchasing gold at a record-breaking clip. Data from the World Gold Council shows that central banks globally purchased a staggering 244 tons of gold in the first quarter of 2025 alone, following a massive 1045-ton accumulation throughout 2024, marking the third consecutive year where central bank buying cleared the 1,000-ton threshold. This represents the second highest institutional accumulation in human history. So while financially distressed nations like Russia and Turkey are forced to liquidate a tiny fraction of their assets, economic powerhouses like India, China, and major Middle Eastern sovereign wealth funds are aggressively buying up every ounce available, their strategic goal is absolute de-dollarization, converting paper fiat currency into unprintable physical gold. India expanded its gold reserves by over 70 tons, remaining the second largest institutional buyer globally, while oil-producing nations like Saudi Arabia, the United Arab Emirates, and Qatar are continuously accumulating gold to insulate their wealth from Western banking systems. So on one side you have a few financially strapped nations selling out of desperation, and on the other side you have an army of wealthy nations hoarding gold for the long term. This dynamic confirms that the institutional perspective on gold has not changed one bit. What has changed is simply the short-term cash flow requirements of individual states. Which brings us to the most dangerous part of the equation. Why is this massive Russian gold liquidation hitting the headlines right at this exact moment in time? Because across the ocean in Washington, D.C., a historical political drama is unfolding that will dictate the future of your retirement portfolio. Donald Trump broke a 40-year presidential precedent by hosting the official swearing-in ceremony for the new Federal Reserve Chairman, Kevin Warsh, inside the White House. Let us look at how abnormal this behavior truly is. Since 2018, the Federal Reserve Chair appointment ceremony has always been held privately inside the Federal Reserve headquarters, with the sitting president completely absent from the event. The last time a U.S. president personally staged a Federal Reserve Chair inauguration inside the White House was all the way back in 1987, when Ronald Reagan inaugurated Alan Greenspan nearly 40 years ago. The only other president who attempted to project that level of political authority over the central bank was George Bush in 2006 for Ben Bernanke. But even that ceremony was kept clear of the official White House grounds, Donald Trump giving Kevin Warsh this unprecedented red carpet treatment inside the executive mansion sends a loud, unmistakable message to the financial markets. You need to slash interest rates immediately because the United States debt machine is running out of time. The U.S. federal debt has officially exploded past the terrifying $39 trillion mark, and the annual interest expense required just to service this mountain of obligations has officially eclipsed the entire United States military defense budget. Donald Trump wants to aggressively implement massive corporate tax cuts while simultaneously expanding domestic infrastructure and fiscal spending. Where on earth is that money going to come from? It can only be generated if the Federal Reserve aggressively slashes interest rates to artificially suppress the borrowing costs of the federal government. This immense pressure on Kevin Warsh is not some random political theater. It is a desperate survival tactic for an over-leveraged empire. Now, you might argue that Kevin Warsh is historically a monetary hawk who is notoriously stubborn about inflation, and he might completely ignore the White House demands to cut rates. That is true in theory, but the historical relationship between a United States president and a Federal Reserve chairman is a fluid, brutal battleground that continuously shifts based on political gravity. Some central bankers end up as complete political puppets, while others turn into fierce institutional adversaries. The critical factor is not the economic philosophy you hold when you walk into the job, but whether your psychological makeup can withstand the non-stop bludgeoning coming from the leader of the free world. To understand what Kevin Warsh is going to face, we must look back at the history of modern Federal Reserve chairs and how they responded to intense executive pressure, because this historical baseline gives us a 75% probability matrix for what happens next. Let's look at the last 8 chairs, starting with William McChesney Martin, who served the longest tenure in history, spanning nearly 20 years across 4 different presidential administrations. Martin boldly refused to act as an agent for the Treasury Department, moving the operational base of the Federal Reserve out of New York and into Washington, D.C. single-handedly, building an institutional moat around monetary policy. Then look at Arthur Burns during the Richard Nixon era, who represents the absolute worst-case scenario. Burns completely surrendered to political pressure, doing exactly what Nixon demanded, which destroyed the independence of the central bank, turned the Fed into a political tool, and directly triggered the catastrophic hyperinflationary crisis of the 1970s. After him came G. William Miller under Jimmy Carter. Carter did not even exert massive pressure on him, but Miller simply lacked the competence and ideological spine to fight rising prices, completely misjudging the macroeconomic landscape and collapsing under the weight of his own errors. Then entered Paul Volcker, the gold standard of central bank independence.